Hi everyone, I am very happy to welcome you all to Dr. JJ's Virtual Academy of Commerce. Through this video, I am going to detail the accounting treatment in relation to the calculation of a few aspects like margin of safety, break-even point, then the number of units to be sold additionally in order to earn the present profit in spite of changes in selling price, and so on. There are two problems I have chosen to discuss with you through this video. Let us first get into the details of sum number 1. The following are the details obtained from the records of X Limited. Sales amounted 1 lakh rupees given. The 1 lakh rupees sales is generated through the sale of 4,000 units at the rate of 25 rupees each. Variable cost is amounted 72,000 rupees. Fixed cost is amounted 16,800. From these accounting information, we are asked to calculate PVR, break-even sales, margin of safety, and how many additional units should be sold to obtain the same amount of profit if the selling price is reduced to 20 rupees. From what? From 25 rupees. So this is what our understanding over sum number 1. Now let us get into the calculation of the first requirement, PVR. What is the formula for calculating PVR? Contribution divided by sales into 100. Yes, we can very well calculate contribution from the accounting information. Sales is directly given in the problem. How to calculate contribution? Contribution is equal to sales minus variable cost. Sales is amounted 1 lakh rupees and the variable cost given in the problem is 72,000. Therefore, the answer is what? 28,000 rupees. That is what? The amount of contribution. Now let us use the amount of contribution and the amount of sales in the formula for PVR. Now, PVR is equal to 28,000 rupees contribution divided by sales 1 lakh rupees into 100. It gives us the profit volume ratio of 28%. Now let us go to calculate the break-even point, which is a requirement as per question B. What is the formula for calculating break-even point? Fixed cost divided by PVR. Fixed cost given in the problem is amounted 16,800. PVR is just now calculated. It is 28%. The answer is what? 16,800 divided by 28%. The answer is 60,000 rupees. That is what? Break-even point sales for sum number 1. Now the third requirement is nothing but margin of safety. What is the formula for calculating margin of safety which is suitable for this situation? Actual sales minus break-even point sales. Actual sales given in the problem is amounted 1 lakh rupees. Break-even point sales is calculated just now. It is amounted 60,000. Therefore, 1 lakh minus 60,000, it comes to 40,000 rupees. That is nothing but break-even point. Then what is the fourth requirement to be done in sum number 1? We are asked to find out the number of units to be sold additionally in order to earn the present amount of profit, present total amount of profit, even after the selling price is reduced to 20 rupees. So from 25 rupees, the selling price is going to be brought down to 20 rupees. Now, we should calculate the number of units to be sold additionally in order to earn the present amount of profit. For that, let us first calculate what is the total amount of profit being earned by the concern in the given situation. That is what to be done first. After you calculate the present amount of profit, you can apply the formula. You can assume the present amount of profit is a targeted profit to be earned in the new situation. Fine. The formula could be fixed cost plus the desired profit or targeted profit divided by revised contribution margin per unit. It will give us the total number of units to be sold at the rate of 20 rupees to earn the same amount of profit. After we calculate the total number of units to be sold, if you subtract the current sales volume, you can very well come to know the number of units to be sold additionally in order to earn the present amount of profit at the revised selling price of 20 rupees. This is a plan we are going to follow to answer requirement D. Now let us calculate the present profit. How to calculate present profit? From sales, if you subtract the total cost, you can come to know the present profit. Sales is given in the problem, amounted 1 lakh. The total cost has got two elements. One is variable cost and the other one is fixed cost. These two are presented well in the problem. So from sales, if you subtract the total cost, you come to know the balance 11,200 as a profit being earned by the business from the sales amounted 1 lakh rupees. Fine. Now let us calculate the sales in units required to earn the profit of 11,200 rupees at the revised selling price of 20 rupees. Right. Fixed cost plus desired profit. Here the desired profit is the present amount of profit. The whole divided by contribution margin per unit. Since selling price is changed from 25, it comes down to 20 rupees. Definitely you find a change in contribution margin per unit. Therefore, you first calculate the revised or new contribution margin per unit. New selling price per unit minus VC per unit, variable cost per unit remains the same even in the new situation. Therefore, the new selling price 20 rupees minus the variable cost per unit. How to calculate variable cost per unit? Yes, we were informed about the total variable cost when the company was producing and selling 4,000 units. 72,000 rupees was the total variable cost when the company was producing and selling 4,000 units. Therefore, if you divide the 72,000 rupees by the volume of production 4,000 units, you can very well come to know the variable cost per unit. That is what I have done here. 72,000 rupees divided by 4,000 units, it gives us 18 rupees as the variable cost per unit. It is the same in the existing situation and the revised situation also. So 20 rupees new selling price per unit minus variable cost per unit 18 rupees, it gives us 2 rupees as the answer of revised contribution margin per unit. Now let us calculate the sales quantity required to earn the present amount of profit. Now, fixed cost 16,800 rupees plus the desired or targeted profit 11,200 rupees divided by revised contribution margin per unit 2 rupees, it gives us 14,000 units. So, if this company sells 14,000 units at the rate of 20 rupees per unit, it is likely to earn the desired profit of 11,200. That's what about the point we need to understand. But the question is what? How many additional units to be sold to earn the present amount of profit at the revised selling price? Now, what is the quantity of products produced and sold in the existing situation? It's nothing but 4,000 units. Therefore, what we do from the revised sales quantity of 14,000 units, if you subtract the 4,000 units, which is nothing but the present sales quantity, you come to know the balance 10,000 units as what? The sales quantity, required sales quantity to be made additionally in order to earn the present amount of profit of 11,200 rupees at the revised selling price of 20 rupees per unit. With that, sum number 1 is over. Let us get into the details of sum number 2. Given details in sum number 2 are selling price per unit 25 rupees, variable production cost per unit 10 rupees, variable selling cost per unit 5 rupees, variable administration cost rupees 4 per unit. Total fixed cost is given with 1,20,000 rupees in the problem. Now, what is that we are asked to do? We are asked to calculate A, BEP, B, new break-even point when the selling price is increased by 4 rupees. What is the present selling price? 25 rupees. It is going to be increased by 4 rupees means the new selling price is going to be 29 rupees. Fine. Then C requirement is what? Margin of safety when the profit is 90,000 rupees at the current selling price. That means at the selling price of 25 rupees per unit. So these are all the requirements to be done based on the accounting information presented in the problem. Now, the requirement A is calculation of break-even point. What is the formula for calculating break-even point? Fixed cost divided by PVR. Now, where PVR could be calculated either with total contribution and total sales or with contribution margin per unit and selling price per unit. So here we are given with the selling price per unit and the possibility for calculating contribution margin per unit easily. Therefore, what I am going to do, I am going to make use of the formula of contribution margin per unit divided by selling price per unit into 100. That is what I am going to make use to calculate PVR. Now, contribution margin per unit should be calculated first. Selling price per unit minus variable cost per unit will give us the contribution margin per unit. So, it's nothing but 25 rupees minus the variable cost per unit consists of three elements in the problem. One is variable production cost, second one is selling cost, third one is administrative cost. Put together all the three gives a total of 10 plus 5 plus 4 is equal to 19 rupees. So from 25 rupees if you subtract 19 rupees of variable cost, you get the balance 6 rupees as what? The contribution margin per unit. Now we are ready for calculating PVR. PVR is equal to 6 rupees contribution margin per unit divided by 25 rupees selling price per unit into 100, it gives us 24%. That is what PVR. Therefore, we can now answer requirement A, which is nothing but calculation of break-even point. Fixed cost 1,20,000 rupees divided by PVR 24%. The answer is what? 5 lakh rupees. That is the value of break-even point in sum number 2. Now, what is requirement B? We are asked to calculate the new break-even point when the selling price is increased by 4 rupees. That means it is increased to 29 rupees per unit. Fine. Now, new PVR should be calculated. When you find change in the selling price per unit, definitely you will find change in the PVR as well. So, let us calculate new or revised PVR. Fine. Contribution divided by sales into 100. That means contribution margin per unit divided by sales into 100. The new contribution margin per unit could be calculated as what? Selling price per unit 29 rupees minus variable cost which remains the same 90 rupees per unit. The whole divided by selling price per unit 29. That's a new selling price into 100. So it gives us 34.48% as the revised profit volume ratio when the selling price per unit is increased to 29 rupees per unit. New break-even point, FC fixed cost divided by new PVR. Fixed cost is the same 1,20,000 rupees divided by the new or revised PVR 34.48%. It gives us the answer of 3,48,028 rupees. That is what the new break-even point when the concern increases its selling price to 29 rupees per unit. And what about requirement C? Calculation of margin of safety at the pre-revised selling price. That means what? At the existing selling price of 25 rupees per unit to earn what profit? To earn a profit of 90,000 rupees. That is what given in the problem. What is the formula? There are actually two formulas to calculate margin of safety. We need to understand which formula is really suitable in the given situation. Formula 1 is actual sales minus BEP sales. You can very well go for it. Of course, but to calculate actual sales, you need further working to be done. Then what about the second formula? Profit divided by PVR. Of course, this is very simple to use in the given situation. We know the profit to be earned is 90,000 rupees directly given in the problem. We have already calculated PVR for the existing situation. That's nothing but 24%. The pre-revised situation, what was the PVR? It was 24%. Therefore, let us directly make use of second formula for calculating margin of safety. What is the formula? Profit divided by PVR. Profit 90,000 rupees divided by profit volume ratio 24%. It gives us the answer of 3,75,000 rupees as margin of safety to earn a profit of 90,000 rupees at the pre-revised selling price. I hope you have thoroughly enjoyed my lecture over this topic, marginal costing. Thanks for your time to watch this video. I'll meet you in another video. Bye for now, everyone. Good luck.